asked often if there is a typical profile of someone who goes on to become a successful money manager, and my answer is generally no. People who succeed in this business take a variety of paths and often have very different backgrounds. Our first speaker today, Liow of Aravat Global, is an impressive example. A native of Australia, he started his career as a consultant at Bain & Company, spending 5 years in its San Francisco, Singapore, Sydney, and Beijing offices. He then earned an MBA from Harvard before joining Ziff Brothers Investments in 2001, where he ultimately became responsible for its investments in media, telecom, energy, and agriculture. He started Aravat in 2014 with more than $1 billion in assets at launch. Drawing on lessons from maybe a somewhat unlikely source, Genghis Khan, Yen is going to speak today on why investors should try never to fight fair fights. Okay, Yen, it's all yours.
Well, thank you very much, John. You can hear me clearly, right?
Yes.
Perfect. Well, listen, guys, thank you so much for joining us today. Thank you to John and Nick and the team at the Capstone Student Investment Conference for this opportunity to speak to you. I'm going to try to race through a bunch of slides over the next 25, 30 minutes, and we'll have a breakout a little bit later this afternoon to go further into Q&A. So let me share with you some slides, and I'll quickly introduce my fund as well while we do it. Okay. Let me introduce my fund. Aravat Global is a fund, as John said, was started in 2014. We're an equity long-short fund, as well as running a long-only strategy. What I'm going to lead into today, first thing I got a question for you is, who's fired up to give everything they've got in their life just to be average? I hope none of you. And so what we're going to try to do is to walk through what is your plan to be amongst the best performers in history, to be at the right tail. What is your quest to achieving the right tail? And the question I start with, are you even the top 5% version of you? Pitch you one idea to give you an illustration of what we do, and then finally give you some tips on discovering what the right tail version of you is. Before we start, I wanted to just frame this. Every single time you buy a stock, you're making one explicit statement. You are right and the entire market is wrong. I want to tell you about the insanity and arrogance of that statement. You're competing against some of the smartest, most motivated people on earth, and literally trillions are at stake. We make this statement very, very carefully, and we do it infrequently. So I wanted to introduce you to Genghis Khan. The reason why I wanted to introduce you to Genghis is Genghis Khan and his tribe of Mongols conquered 10 million square miles of this earth in 30 years. That's the equivalent of Canada through to Brazil. This is the extreme right tail of history. The point here is you can't do great things if you just follow the crowd. You need to be different, and it needs to be coupled with being better. In Genghis's situation, this was massive strategic advantage coupled with tactical advantage and world-class execution. It requires both to achieve the level of historic greatness that he did. My firm is actually named after Genghis Khan's army. The starting point of our strategy is three key central tenets. The first, as John touched on, is never fight fair fights. When it comes to capitalism, an equal fight is not an advantage strategy to compound capital over long periods of time. The second element is train very hard. This is an industry where low frequency, high impact changes outcomes dramatically. And then finally, all we seek to do is try to do good things with good people. So what is at stake? And a few tips for you, the students and young investors out there. You can literally decide today, it is 100% in your control how fast you learn and how successful you will be. The quality of your life is at stake, and it sits right on the other side of focused effort and tremendous struggle. Today, I'm going to try to equip you with a few tools to make your journey a little easier. Spoiler alert number one, there is no shortcut to success. However, there are ways that are much longer. Spoiler alert number two, There's no such thing as the perfect way to invest. There are lots of strategies that work. However, there are again ways to make it harder. This is the Investment Hall of Fame. If you were to come into the public market investment realm, you might as well know what greatness looks like. And amongst this list are many of the greats. I will caution that some of this data I find a little noisy. But let's put a benchmark out for you. And some of the speakers that have already presented at this conference are going to be firmly cemented in this when their careers are over. If you put up over 15% for over 10 years track record, you will probably get in the room. If you put up over 20 for 20 years, that'll make you an investment legend. So the quest in all of investing is compound math. You want to unleash this profound mathematical lore, and you want to play it to your advantage. So if you have the ability to compound capital at 20 for 20%, 20 years for 20%, that will equivalent compound your capital and your partner's capital 40 times. That's transformative. And this is one of the quests that we have in investing. So how do you do it? There are 4 steps to long-term compounding, and all 4 need to be mastered. It's multiplicative, they're not additive. The first is a strategy that allows you to be deeply invested through cycle. The second is a strong IRR. The third is long duration, and then finally tax efficacy. It's not what you make, it's what you keep in investing that matters. In dissecting the right tail of investors, these are a few patterns of the Hall of Fame. We're going to dive into 4 of these today. The first and most important one is they survived. That is a non-trivial factor in an industry as competitive as ours. The second is they are highly process-driven. The third is they have a basis to predict outcomes. This is where the unfair fights comes in. Fourth, the ability to assess and price risk. An ability to navigate volatility and mistakes, something I'm going to focus a lot on today to equip you with 4 techniques to navigate the volatility that is inevitable in your career. And then finally, having the boldness to act when opportunity presents itself. So investing, the arena of investing is a blood sport. It's a full contact blood sport. And you have to train like a professional athlete to survive, yet alone thrive. It's a very lucrative industry and it's hyper competitive. So survival starts with this simple statement. To finish first, you must first finish. Many of you have studied Warren Buffett, the investor. I want to touch on one element of Warren Buffett, the businessman. I think the outlying genius of the man is actually how he structured his life and his business. This is a massive unfair fight. Warren and Berkshire Hathaway are structurally advantaged almost beyond any fund in existence today. The 20% returns is impressive, but as you saw in the Hall of Fame, there are others who could emulate it. He did it for 60 plus years. This is an incredible outlier. But what is truly extraordinary is he has survived 3 down 50+% drawdowns in this time. I'm not sure if any fund in the modern era could actually survive this. And he's done it all very tax effectively. So at the start of your quest, one of the most important bearings is understanding what your investment philosophy is. And I define an investment philosophy as a set of beliefs and principles that guide your decision-making process. This is your true north. And the clearer you are about how you want to exploit inefficiencies and how you want to spend your time over the next multiple decades, it's very important to drill down and understand the essence of your philosophy. And again, we'll share some tips on that today. The second part of this is process. Investment processes are a set of guidelines that govern your behavior and allow you to remain faithful to your investment philosophy. To perform at the highest levels for the next multiple decades, you need an investment North Star and a process that is repeatable, refinable, and scalable. I don't know of any skill in any profession that doesn't have these elements. You need something that can be repeated to be refined, and to perform in the investment world, it needs to scale over time. So volatility, this is a very big topic. And price volatility is both the price and the provider of performance. You need to know how to survive it and then how to exploit it. And I'm going to give 4 tips in a minute. So taking the hits. This is Mike Tyson, who was the heavyweight champion for many years, a few decades ago. The question is not if you're going to take a hit. The only question is, how are you going to take the hits? There's going to be many big hits along the way, and it's something you need to know how to endure. So volatility, there is a time almost once every decade where it is so extreme, we call it almost zero visibility instrument flying. So this was actually a plane, a Turkish airline, in 2017 that was hit by such large hailstorms that it completely shattered the front end of this A320. This is the experience sometimes in investing that we have, and you need a system pre-thought through in advance to help navigate such moments. So here are the 4 tools that I wanted to share with you today. The first is I'm going to touch on awareness. The second is on game selection. Third is on mark versus permanent capital loss. And then finally, a system when volatility hits, which is the thought process of holding through versus adding down. Let me start with awareness. These are some base rates for you. We have literally studied hundreds of north of 20% compounding stocks over rolling decades. This is the extreme right tail. This is 3% of securities that are the best of the best in capital markets. The base rate tells us that almost every single year, they have a 15+% drawdown many times. The second is they draw down 20+% most years. And then finally, every single decade, they draw down 50% or more at least once. And again, this is for the best of the best in every rolling decade that we've studied. We can't predict when these drawdowns will occur, but we're not surprised when they do. So to give you some examples, this is Mercado Libre. This is one of the most successful stocks over this past decade. It's been a 36% CAGR, or 22 times your money. The percentage of the time that it spent 10% below its all-time highs was 58%. Percentage of the time that it spent 20% below each all-time high was 31%, and it experienced a 46% drawdown. In order to capture this level of performance, volatility is just a natural companion on that ride. Amazon, another incredibly successful stock this decade, similar characteristics. Up 30% CAGR, 13 times your money, spent a third of its time 10% below the all-time highs, about 12%, 20% plus below their all-time highs, and a max drawdown of 34%. This system applies, and this pattern applies to almost every one of these high-performing stocks each rolling decade. So the second part of this is called game selection. And this is where it's really, really important. So choosing a wise game is the most important decision we as leaders and allocators will ever make. This one decision will determine where you spend all of that energy that is going to be expended into your career over the next multiple decades. My strong advice is choose wisely. You need to pick a game that you can win repeatedly, and it's valuable. And I can assure you that no amount of effort or skill will overcome a poor choice of game selection. So what do we mean by game selection? So first, to withstand and then exploit volatility, it's a dance between price and value. And decisions are just so much easier when one side of that equation is more predictable. Volatility, by definition, is uncontrollable. So the left side here, the chart is time is the x-axis, price and intrinsic value is the y-axis. The squiggly line is price volatility, and the straight line on the left side is intrinsic value. The point here is price and intrinsic value. If it's constantly moving together, it's very, very difficult to arbitrage, as is the right-hand side. It's just easier when one side is more predictable. You can only get the setup on the left-hand side is if you've chosen your game wisely. So I want to introduce you to a concept called low versus high prediction environments. Low prediction environments, if you operate in a higher prediction environment, it will give you a basis to predict value or outcomes. But that ability is determined on whether you've chosen the right environment. So what is a low prediction environment? A low prediction environment means there's a very weak correlation between what has happened historically and your ability to predict the future. So example is flipping coins. A high prediction environment is where there's a very strong causal relationship between history and your ability to predict the future. So those are subscription type businesses or annuities. So this is from the 18th century, a United States Treasury. Hopefully, it doesn't become flipping coins in the near future. So let's bring this back. When you operate in a higher prediction environment where the past and the future are easier to link and to predict, price volatility now becomes your friend. You're operating on the left side of this chart where one side is fluxing and the other side is more steady. That is a high prediction environment. Those are subscription businesses, annuities, and monopolies. On the right-hand side is the low prediction environments. These are highly competitive industries and commodities where both price and intrinsic value are fluxing at the same time. It's very difficult to systematically arbitrage, or at least it is for me. The next point I'd like to bring alive for you is this notion of efficient versus inefficient markets. This is also a choice of where do you want to spend your time, and this will determine how much you make. An efficient market, I define as a market where no one can consistently win. And this can be caused by two things. One is it's just too competitive, or it's just unknowable. Either way, skill can't consistently arbitrage significant profits over time. In contrast, inefficient markets are situations where profits can be extracted or mined repeatedly over time. Now, this is quite distinct from competitive versus uncompetitive markets. So competitive markets are where there's a large number of participants, very liquid markets, for example, US large cap or global macro. Less competitive markets could be illustrated by microcap or frontier markets or highly technical markets. One of the goals in your game selection is compete in less competitive or less efficient markets more specifically, and then your profit streams are likely to be larger. So let's bring this alive. What is the questions? The question that you actually really are faced is what is the basis of inefficiency and then how you're going to exploit it. Now, I would note here that there is no distinction between competitive and less competitive markets. Both can be efficient and both can be inefficient. The question when they're inefficient is it temporal or is it structural? This is the game within the game. So for example, in the less competitive markets of microcap, an efficient microcap could be a company that is literally unpredictable, or a frontier market that has too many variables in order to overcome the beta of the market. The alpha is not enough to overcome the beta. In general, microcap and frontier markets are less efficient. Why? Because they're structurally inefficient in that there isn't so much capital that large funds and large banks have all the resources to do all the research to uncover all of those ideas. That would be a more structural inefficiency. But it also exists within the whole segment of microcap or frontier. I would argue that the majority of both of those are actually efficient. Situations like US large cap and macro, by and large, are quite efficient, very difficult to systematically outcompete. However, temporarily, they are always producers of moments, if you're ready, of tremendous temporal inefficiency. And if you're structured and prepared, you can exploit them at scale. The third tool in navigating volatility is understanding the difference between a mark and permanent capital loss. This is what we call the bottom of the Nike swoosh. So the setup here is time is the x-axis, price is the y-axis, the black line squiggly is price volatility. Now, the difference between marking risk and permanent capital loss is the difference between opportunity and risk. And this is the moment we train for. So what is a mark? A mark is purely when you have a lot more motivated sellers than motivated buyers. This is really painful, but it is temporary. The difference from permanent capital loss is you are just wrong, and the stock is never coming back. It's really painful, and it's permanent. So a situation of a permanent capital loss impairment would be a drug going through FDA approval that fails. Before it was an unknown, now it is definitively it is not going through for approvals, and the stock will re-rate down, and it is not coming back. That is a situation where the stock is down 30 or 50, and it's never coming back. Knowing the difference between that is a tremendous source of skill, and frankly, it comes back down to game selection. The fourth element I wanted to touch on here is having a game plan when volatility hits, and that's holding through versus adding down. The number one protocol we use for volatility is we hold through. We do not try to just add down. I find that a very adrenal impulse that most people say, if you're high conviction, you should be always adding down. I just don't believe that. The opportunity cost of dry powder when your portfolio is filled with companies that are compounding earnings at a very brisk rate is very high. We are not a firm that holds a material amount of dry powder. And if you're all in on a stock, literally the most important question to answer is, are you right or wrong? Not should you be adding or not. We add if we can and rotate, but it's not the first imperative. The second volatility protocol that we employ is if our stocks are down over 300 basis points of alpha from the peak, we don't add incremental risk. 300 is just an arbitrary number. That's what we use. And the reason we do that is despite a very high batting average in our firm, I used to work at a company called Bain & Company, and they had a thing called the 1% possibility. There, what they meant was there's always a 1% chance that we could be wrong. And in investing, that number is actually closer to 30 to 50%. Henceforth, there has to be some systematically pre-thought through approach that doesn't just throw good money after bad. And when you're really big, the most important decision is, are you right or wrong, and not putting the entire enterprise at risk. I'm going to jump through now to translate some of this to Aravat Global. So how did we choose our game? The first and most important part of our departure was understanding pattern recognition. How did we systematically break down this vast universe of investment opportunities to a finite set of ideas to give us a chance of creating sustainable superior returns? And most importantly, to focus our time. That is by far the most important and scarce resource we have. And this is what we did. So we embarked on a very deep study of history. This took over 10 years. And choosing a game, we said, let's study the patterns of history. And this was a study from 1990 through 2016. And we're studying the right tail of businesses that compounded at over 20% for 5 and 10 year rolling cohorts for above $2 billion market cap equivalent at the start of it. There was 90 stocks that could do above 20% for a decade, and 645 that could do over 20% each rolling 5 years in that 26-year period. And we broke down and studied many of them, hundreds of them, and it broke down into 3 frameworks. I'll share with you what the one that we chose. The game selection for us is, and what we do, is we hunt horses. We define horses as monopolies and oligopolies that compound earnings per share at 2 to 3 times the broad market average for long periods of time and trade what we believe are to be reasonable prices. It's a very finite form of GARP. This is our true north. Our true north, we believe in our investment philosophy that over time, earnings per share or free cash flow per share plus dividends drives total return. So the x-axis here is time, the y-axis here is price and intrinsic value. The blue line is what drives intrinsic value, and then the squiggly line is volatility. With this industrial design, and by the way, we believe in the short term there are lots and lots of ways to make money. We believe on a sub 3 year time frame, multiple impact total return substantially. Beyond 3 to 5 years, its impact is minimal. And the most important if you're a long-term investor is that you get the durability and the rate of compounding right. And over time, it will remediate any errors on multiple. And then finally, if you're seeking tax-effective returns, this is actually the only strategy that will work. If your strategy is based on trading intensity, by definition, you're not tax efficient. So bringing this together again on game selection, for us, by choosing monopolies and oligopolies, our stocks may be more volatile at times, but our businesses in general are not. By choosing monopolies, we've got an intrinsic value that's steadier to predict, still not perfect, it's less volatile, and it pushes our game to the left-hand side. This gives us a bit of an unfair fight against the market. So how do we do it? This is our process. We take this global stock universe of about 3,000 stocks, and we filter it through 8 filters that took us many, many years to refine. And that creates 3 portfolios. So the first is just a curated book of about 200 to 300 stocks that have gone through those 8 filters. And then our second book is where we spend all of our time. And that's where our fully researched prepared inventory. And then finally, it's drawn down into our live portfolio if and when we need it. So let me pitch you an idea. The idea is Evolution Gaming. This is a Swedish listed stock. It is the 800-pound gorilla within the online casino space. In SaaS, the rule of 40 is an illustration of quality, the combination of revenue growth and profitability. This is the rule of 100. the Evolution has been growing revenues at over 50% with 57% EBIT margins, and this past quarter grew earnings at almost 100%. It's a 20 billion euro company that's trading at approximately 40 times forward. So what does Evolution do? It is the leading live casino company where its clients are the online casino distributors. So DraftKings would be an example of being a client. They provide all the games on the bottom of this chart. They're live croupiers for live casino in the digital realm across all the devices you see on the top. These live casino operators, the croupiers, are actually in Latvia and Georgia at the moment, about to go into all of the United States legalized states as well. And it's transmitting through all those devices, and they are the provider of those games. So here's the 2-minute pitch. The moat is based on product development, operational excellence, and customer captivity. They have a 70% share of online live casino globally right now, and they're 10 times the size of their next competitor. The reason why product development is so intense is this isn't just playing blackjack or baccarat. They have a full suite of everything from slots to far more innovative and fun games. The operating infrastructure for payment security and zero lag transmission is non-trivial, and they have perfected it globally. And then finally, from a customer captivity perspective, we've found that players are more loyal to Evolution's content than the distributor they play through. The TAM here it's a $400 billion TAM. About 13% right now is online, of which Evolution has a 1% of global gambling win. We believe Evolution's future potential market share here could be many, many-fold that number. Europe is the most progressive online market in the world. That's about 23% online at this point, which Evolution has 8% share in and growing dramatically. The United States has just started legalizing online gaming, and just following live sports bet, you can see the progress in the rate that is growing, and we believe that online casino is soon behind it. Online penetration at the moment is only 3%. Asia is a massive market, and Evolution has yet to even build an Asian studio. So we believe Evolution will grow earnings for well over 30% for a very long period of time. In fact, we expect earnings to four times or quintuple over the next 5 years. They grew it at over almost 100% this last quarter. The market's growing at about 10% on online gambling, and live casinos growing 10% even faster than that, and incremental margins are extremely high. This is a company with no debt, where management and the board controls a quarter of the company, trading at a reasonable price, with regulatory being the number one risk. So let's switch back to the personal right tail, and we'll be concluding in a couple of minutes. This is Michael Jordan. And Michael Jordan is arguably one of the greatest athletes of all time. And in the middle of his basketball career, he decided to take a sojourn into baseball. And what he found was, despite being on the top of his athletic prowess, he couldn't convert his skills in basketball into baseball. The point here is that strategy needs to meet skill and your temperament. Just because a strategy is proven doesn't mean you can execute it at a world-class level. So for those of you who've ever taken a golf or tennis lesson, this is what I want you to bring back to investing. No matter how many lessons we take, most of us are not going to be Roger Federer or Tiger Woods. So your personal right tail, my hope for you is you want to be the best version of you. And as you can see here, this is Jeff Bezos from 1998 and then 2017, and you can read the captions for yourself. In closing, the right tail, you need to combine the strategic right tail, find strategies that you know you can repeat and refine and scale over time, but you also need to make sure it matches the right tail version of you, and then you have a shot at the investment Hall of Fame. So how did this translate for us? Well, I know there's 3 strategies that define the right tail, and although we proved that we're world-class at 2, there's only one that matters that fitted our skill and our temperament. And then in closing, I wanted to share with you one last insight, and this is rewiring your relationship with pain. Fully embrace the struggle as your partner to excellence. It's a constant in anybody that is achieving more and having more responsibility thrust upon them. The difference between struggle and suffering is purely down to context. It's understanding your why. Struggle is pain with meaning. Suffering is pain without meaning. And if you're struggling, it means you're growing. It means you're learning. In fact, it's the neurological precursor to insight. And once you understand